Hi guys! I decided to take a short summer hiatus for the month of July. But don't worry, I still have an episode for you. It's an encore presentation of a CSIA virtual event panel discussion called Business Value, GPS for Your Business. Now, I know what you're thinking. What the heck does that have to do with me? And it's simply this. Understanding what your boss or your boss's boss or your boss's boss's boss cares about is a powerful tool for you to leverage in your own career. Moderated by Bryan Powrozek of Clayton McKervey, the panel explains the key levers that drive business growth, the pitfalls in valuing a business, and even some basic concepts like cash is king and the value of clean books and KPI dashboards. Even if the concepts have nothing to do with your day-to-day responsibilities, listening to this panel discussion is like eavesdropping on the boardroom. And who doesn't want to do that every now and again? Until next time.
I am Bryan Powrozek with Clayton McKervey, and I get the honor of moderating today's panel. And so just kind of a quick little background on how we landed on this topic and why we felt it was important to bring this to the membership. But in our roles, working with a lot of different system integrators on their businesses, one of the things that we often get asked and get questioned on is, making decisions on their business. Is this the right thing for us, adding this product line, adding this service? And a lot of those questions are very challenging, usually because it's never a really cut and dried answer, right? Is strategically, does it make sense, et cetera? So, one thing that we've found in working with our clients, though, is that if you bring this idea of value into the conversation, it really helps take out some of that emotional component of decisions and gives you something to focus on that's going to be pretty consistent, as you're going forward. So hence the title of the webinar and our focus here is how can a business owner use their business value to guide decision-making, guide strategy, et cetera. So with that, I'm going to quickly kind of go through and have our panelists introduce themselves. So Jane, if you wouldn't mind giving everybody just a quick introduction.
Sure. Good morning, everyone. Thanks for joining. My name is Jane Tereba. I'm the president of Capital Valuation Group. We are a boutique valuation firm that's actually located in Madison, Wisconsin. All we focus on is business valuation, and if anybody happened to get into a litigation setting, we can help determine financial damages in a litigation setting. We've been in business since 1974, and all we focus on is business valuation.
Clint?
Hi, Bryan. Thanks for having me on today. I'm Clint Bundy, managing director with Bundy Group. So we are a boutique investment bank and mergers and acquisitions advisory firm. And what we do is we specialize in representing business owners in really one of two major events, either a business sale or a capital raise. And what we're almost always doing is helping that owner in a sale or capital raise maximize their valuation, as well as find the best fit for them from either a buyer standpoint or a capital partner standpoint. We've been active in the automation space now for well over a decade and been a member of CSIA for a long time, and excited to be on the panel today.
Excellent. Thank you. And last but not least, Ben Smith.
Thanks, Bryan. Good morning, everyone. So my name is Ben Smith. I am a shareholder here at Clayton McKervey. Clayton McKervey is a full-service CPA firm that has a heavy focus on system integrators. I sit within our consulting practice. Most of what I do centers around transaction support, doing financial due diligence, and then also leading our digital advisory practice.
So Jane, I'll start with you. In my intro, I kind of based this whole conversation around business value. And just so we're all kind of on the same page when we're using that term, can you give me just a baseline definition of business value?
Sure. So everybody knows if you own stock in a publicly traded company, it's very easy to determine its value, right? You can look at your investment account, you can research the stock online. But as we also know, if you own stock or equity in a closely held company, there is no market reference to determine its value. So what we do and what we're going to talk about today is how you figure out that business value of a privately held company. And so when we're thinking and talking about that today, we're talking about the price at which that ownership interest would transfer hands or change hands between a willing buyer and a willing seller, neither being under any compulsion to buy or sell, and both having reasonable knowledge of all facts. So we're essentially trying to determine what would be reasonable for the company or that equity interest to transact between two willing buyer and willing seller. And the last thing I'll say about valuation, and I'll come back to this, I'm sure, more than once today, is that valuation is about two things. It's about cash flow and risk. What is a buyer buying? What is a buyer selling? So when we're talking about value, we're talking about the combination of those two things. The future economic benefits of the company are the cash flows. How profitable will the company be after reinvesting in its infrastructure? And then those future economic benefits are impacted by the risk in the company. So those are kind of the topics we'll kind of circle around, I'm sure, today, that the value of your company, the value of the equity that you might own in your company is going to be impacted by the future, because a buyer is always looking forward. What is my return on investment going to be in the future? How am I going to earn a return on my investment going forward? History is great, and it will instruct us as to what the company might be able to accomplish in the future. But it's all about looking forward and understanding the risks and opportunities within a business model that will be able to support those projected cash flows.
Excellent. And so, Clint, the next question then will go to you, because as Jane kind of laid it out there, the value is usually thought of in some sort of a transactional capacity, right? Somebody purchasing the ownership interest in a business or selling the ownership in a business. And based on your experience, I mean, that's what you do day in and day out, right? Is facilitate those transactions. Can you explain the process of selling a business? I mean, I know that that's one thing, most privately held business owners may go through this once or twice, in the course of their career. So can you kind of explain that process a bit and maybe give us some of the different ways that a buyer might look at a transaction versus a seller?
I'll divide this into two parts. First, process, and then maybe give you the buyer versus seller lens. Process at a very, very high level. We could do a whole separate webinar on process, but at a very high level, I would divide it into kind of three phases: the preparation phase, the marketing phase, and then the closing phase. Preparation phase is where the owner and his advisors, whether it be transaction accounting, where we've got Ben on the phone, so we could have the whole topic on sell-side quality of earnings reports, which, by the way, Bundy Group's a big fan of, or an investment banking advisor like Bundy Group, or your regular CPA firm, if you have a separate one from your transaction accounting, or even your personal financial wealth advisor. Those are all part of your deal team, plus a deal attorney. They're all kind of helping you get ready to take the company to market to talk to buyers. And we're big believers. I mean, Jane did a great job articulating valuation. Ultimately, in our view, the final valuation is determined by a competitive marketing process, which is what we're usually very involved with in running. So the preparation, you kind of get all the materials together, the details. The marketing phase is you have buyers sign non-disclosure agreements, and you approach, whether it be a small select group or be a broader group of buyers, to generate that competition and interest. And there's several milestones you hit within that, which, again, for the sake of time, I won't get too in the weeds on that. And then you get into the closing phases, where you're usually by that point have signed a letter of intent with the buyer that you've selected. Hopefully, if done the right way, maximum valuation and terms, and it's a great fit buyer. And then you complete out the confirmatory due diligence and close the deal. So those are kind of the three phases at a very high level process. The seller's kind of view, in our experience, because we're representing sellers almost all the time, is that their end goal is, help me get the right value, help me get the right fit, and help me get this deal done. And hopefully do it with as minimal headache as possible, because, hey, I still got a business to run. The buyer's view is they want to buy a great company. And let's be honest, those buyers, if not all, want to buy at the best valuation to them possible. But they do want to get a deal closed. So at the end of the day, it's making sure alignment is there for both sides to get a deal done. A friend of mine once says every closed deal is like a mini miracle, and there's some truth to that. But from my Bundy Group side, our alignment is usually with the seller, so we want to make sure they land in the best possible position.
And I've got to imagine, Clint, sometimes, especially like if it were private equity, deal, and I'm not saying private equity is, soulless or anything like that. But I think what I've seen on some of the transactions that go through is the seller, they've got the relationship with the people. They want to make sure that the company is taken care of on the end. So they may bring a few additional considerations to the table than the buyers. The buyer is really mostly concerned about the value and the strategic fit for their larger plans and things like that. So are those some issues that you tend to have to tackle when going through a transaction?
Yeah, they are. A buyer, this kind of goes back a little bit into Jane's question around valuation, but it really goes to the heart of what a buyer wants, which is whether you're talking private equity or strategic, really they're buying a company to generate ultimately a return. And that's both for strategics. They may view it in a little bit different way, but still at the end of the day, this is all about a return for them, as well as a private equity group. A seller is, of course, thinking, I need a good home for my business and I need a maximum valuation. A buyer is going to say, well, I'm going to look at the past and the present, but what really I'm buying is the future. And what can I do as the buyer in partnership with the management team or the employees or what have you to grow this in the future to get my return on investment?
So Ben, then kind of building off of what Jane and Clint have both already talked about, there's this transactional component when you're talking about business value. Ultimately, that's kind of the end goal. But with knowing that in mind, and I think any of the business owners who are here on the call today, they don't own their business just because it's a hobby and something they want to do, right? Their end goal is to really, when that final transaction does come into play, get the most that they can for all their years of hard work of building this and growing it. So in the work that you've done, what are some other ways that business owners can use this concept of business value more strategically rather than just focusing on a transaction?
I think that's a good question. And when I talk to business owners, oftentimes they have a fuzzy definition of what value is, or they have kind of the baseline down that Jane mentioned earlier, where it's about cash flow and it's about risk. But what they might not realize is there's probably 6 to 8 different levers, depending on how you bucket them, that impact business value that business owners can pull to impact their business value. Okay. And you can kind of use those levers in business value as a North Star for your business. So most business owners have a purpose and they have a mission. They've got that driving force. Business value can be seen as kind of a measure of how well you're executing on that mission, that drive. Okay. Generally, your business value increases when you're working on the right things. And those 7 or 8 levers typically are what I would call kind of a win-win if you think about it. And I'll explain what I mean by that. As I mentioned earlier, I do a lot of quality of earnings studies. In that process, we spend a lot of time talking about the quality and integrity of financial data and business data in general. Quality of data is a big driver in the value of a business. And when I talk to business owners that are thinking about selling their business, one of the things that I bring up is, talking about the quality of their data. We talk about how a buyer might see their data, how they see their data. We might talk about some of those gaps in perception of data and things that they could do to mediate those gaps. I'd say 9 times out of 10, by the time we end one of those discussions talking about the quality of financial data, the business owner is walking away from that conversation saying, whether I choose to sell or not in 5 years, doing some of these measures, completing some of these measures that we talk about, it's just good business. It's going to help me run my business. It's going to make my life easier. It's going to de-risk what is oftentimes one of the biggest assets in my portfolio. So it's a win-win in the sense that you can strategically align these levers or weave these levers into your business strategy. And whether or not you want to sell, you're going to be in a better position long term.
And I know in the conversations you and I have had around this topic, as you mentioned, it's one of the largest investments in most business owners' portfolio. So why would you look at it and treat it any different than any stock or bond or mutual fund that you have? That you got to look at it on a periodic basis and say, hey, am I getting the return out of this that I would expect? And the only way to really measure that return is looking at the value. And has the value grown over time the way I'd expect it to?
OMG, can you believe it's the middle of the year already? If you're like me, that's shocking. On the upside, it means I can offer you something special if one of your goals for 2022 is to join CSIA. And why wouldn't you? This 500-member global community has so much to offer SIs, from best practices to certification to professional development, and even access to professional services experts, including insurance, financial, and legal, who understand the SI's unique business needs. For partner members, CSIA offers an ecosystem to grow your SI programs, understand your customers' pain points, monitor industry trends, and share your thought leadership. Best of all, CSIA is a soft place to land. By that, I mean it's a community of like-minded people who are willing to share, commiserate, and celebrate your wins, your losses, and your vision. So what are you waiting for? Oh, you're probably waiting for my special offer. Here it is. For the months of July and August, membership dues and all Industrial Automation Exchange upgrades and packages are half price. And no, this is not half off like I am crazy Jimmy yelling, everything must go. It's really just because CSIA prorates its dues. But boy, that lacks excitement, doesn't it? To find out more, visit www.controlsys.org/shine. Wait, maybe I should go the crazy Jimmy route after all?
To kind of expand a little bit, and this, really, I kind of viewed the first set of questions as just laying the foundation for the rest of the conversation. But to touch on something you mentioned, Ben, that a lot of these decisions are, just good business sense, right? Like an example of that would be, say, customer concentrations, right? Everyone knows that you don't want all of your eggs in one basket. Because I think that's one of the levers that you talk about too with the QOV stuff. Can you kind of walk through how that would be viewed from a valuation perspective and therefore, why it's important and it makes good business decision?
Yeah, so just talking about kind of the levers in general, Bryan, or?
Yeah, if there was a question from Howard here in the chat that if you wouldn't mind mentioning those levers, what they were, or we can send some of that out later. But I know customer concentration is one of them. So let's maybe look at it from that point. We can get to the rest in the subsequent conversations.
When we talk about business risk, kind of going back to what Jane was mentioning earlier, buyers are buying future cash flow. And if your future cash flow is heavily dependent on a single customer versus 10 or 15 different customers, there's a bigger chance that that customer might be unhappy, not like the new buyer, what have you, and walk out the door. There's just less risk in general when you've got that revenue or that cash flow diversified amongst a larger client base. There's less risk or chance that they're all going to get up and walk away.
Jane and I did a podcast a couple months ago, I think, on this topic. And in a way, I almost equate it to buying or selling a house, right? Because you go in, you agree to the purchase price, then you get your inspection, and then you haggle over as the roof, too old and it's going to have to be replaced soon, or, is the air conditioner going to go out and therefore I need to reduce the value of what my offer is. So Jane, specifically from your experience and your expertise, what are some other areas that you see, that impact the value that owners might not necessarily be thinking about?
So I would just kind of dovetail off kind of what Ben said about the quality of earnings and the quality of financial data. It's so important. The first thing that we do when we do business valuation with an owner is we'll get 5 years of financial statements, historical financial statements, income statements, and balance sheets. And we look pretty detailed at the company's operating expense structure. And when there are fluctuations in expenses or something's classified one way one year and classified one way a different year, and it's explainable, but it's showing, some fluctuations that you wouldn't necessarily expect. Not that that's going to cause questions, but it might. And the more consistent that you can make your accounting, the more you can work with an outside accountant to either do a compilation or a review engagement for you to lend credibility to those financial statements, the better. Because again, I'm going to go back to what I said before, and what everybody else is kind of echoing, is that it's cash flow and risk. And if we can't rely on the historical cash flows, it's going to call into question whether we can trust the future cash flows. So that's one of the things that we'll look for is, And a buyer would look for is, how reliable is the forecast that's being developed? So that's one of the risks that we would look at to say, hey, business owner, if you want to work on your business and increasing the value, clean up the accounting so that going forward, there's more credibility in your ability to forecast and make sure that the accounting is smooth and consistent. Ben also mentioned another one that we always look at, and now switching to the risk side. So being able to look for ways that you can decrease risk within your business. And certainly Ben's right. If most of that cash flow is dependent on one customer, that increases the risk to a buyer, because if there's something that goes south with that relationship, then the eggs are gone. I'm sure you all know there are ways that you can mitigate that if you're able to put in contracts in place. Sometimes we've seen where there are large relationships with customers, but they're with like different departments. So sometimes that helps to mitigate, where you don't necessarily just have one person you're working with. There might be some ways to diversify the relationship. And certainly when we're looking at it from a value perspective, we're looking also at how long has this customer been a client? Is it somebody that's known to be fickle, like a Walmart, or is it somebody that you've been with? So there are ways to mitigate that risk, certainly. But switching kind of gears, back to the cash flow and risk, focusing on the cash flow is one of the things that you really can do to manage proactively your business value to increase the value. When you think about cash flows, what we essentially mean there is revenue, less your expenses, less your reinvestment in fixed assets in general. So the most impactful way to increase your cash flows, if you're able to, is really focusing on the efficiencies of that gross profit line. And that, revenue less direct costs. So I know a lot of you are engineers and don't have technically, like a manufacturer has direct costs of materials and labor. But the more you can do to increase the efficiency of the jobs that you're performing, the more impact you'll have on growing the company's value. I just spent some time with a client a couple weeks ago, and they have such a unique value proposition. And I was kind of trying to figure out where it was in the cash flows. And they went right to the operating expenses and said, oh, well, we could probably save a few $1,000s on our telephone expense if we did such and such. And so they go right to looking at those operating expenses. And while those are important, like I said at the beginning, to make sure that they're consistently reported, making the tweaks to those isn't necessarily going to be as impactful as trying to, increase sales and increase the gross profit margin or the revenues less the direct expenses. So it can be helpful, but people tend to take too much time really refining those operating expenses when the true bang for your buck comes up a little bit higher. Some of the other risks that we often see, as well as the customer concentration that we talked about, some of those levers, the 7 levers, we kind of look at a basket of 10 to 12. And some of those are how reliable is the forecast that you're relying on for the business value. Customer concentration, certainly. Vendor dependence is another one that we look at. Those are the ones that tend to be commonly present in most companies that we value. The other one is dependence on key management members. It's kind of unavoidable when you're owning and managing a small privately held company, but the more you can do to really develop that next level of management team, the more the risk gets diversified away from who probably are the owners, right? So the risk to the buyer is that owner leaves and now nobody knows what to do because they're gone. So really having a nice, solid management team and potentially having employment agreements with them that reduces that risk to a buyer, knowing that these people who are so well educated in what the company does are likely to stay. So that would be one way also to diversify some risk, is really to focus on the key management team and really, delegate, not just in words, but actually delegate to the team. Because we've seen that too, where people say they have this team, but they still do everything themselves, but really push that out and develop that team.
Yeah, it's interesting. You touched on a couple things. I want to kind of go back and get the whole group to kind of chime in on their thoughts on it. But we'll start there, because I think we've all seen and worked with the businesses where everything is in the business owner's head. They really are the company. Yeah, they've got staff around them that get the day-to-day work done. But when it comes to the real engineering and the business development, all that, it all resides with the client. I'm thinking of one client of mine in particular. He's not a CSIA member, but he is the business. And we meet a couple times a year. He talks about, I've got to develop my staff and I've got to bring these people up. But it's one of those things that just never gets done. So that's one of the interesting things to me is, this bringing business value into it now kind of maybe gives you a little extra motivation. Because as you said, if you were to sit down across the table from that owner, you're going to say, well, if your EBITDA is this times a multiple of this, we're going to discount that by whatever amount because you don't have a strong team around you. Is that, essentially kind of how it plays out?
Exactly. Yep.
So going back, and you mentioned cash, and Ben talked about it too, there are some other relatively simple things that business owners can, and may not change the way they're doing things, but to at least think about. I think one thing we run into a lot with privately held businesses is maybe the owner doesn't draw a salary. They just take distributions at the end of the year. So when you look at their income statement, they're very profitable. But then the buyer is going to come in and look at that and say, well, where is your management compensation? And we need to adjust that down. And sometimes that's a little bit of a bitter pill for people to swallow. So are there any other things like that you guys have seen, which there may be a very good business reason why the owner is running things the way they're doing it, but not thinking about it, they could put themselves in a position where they could be subject to a discount?
Yeah, I see there are two other places where we see pretty commonly. One is if you are renting, so the operating entity doesn't own the space that you are in, so you've got a related party that owns the property, and that rent between the operating company and the real estate company is set, however, usually tax motivated, it's set. Not necessarily market driven. That's another adjustment where we'll commonly make an adjustment for what is actual market rent based on the going rates in the community. The other thing that we sometimes see is tax planning. So companies are trying to accelerate expenses or accelerate deductions such that they're minimizing their tax liability. And so sometimes that can be, they'll come and say, oh, and by the way, we have all these things that we did because we're managing our bottom line, and the buyer isn't necessarily, now you're telling me that this is not really reliable again. So again, back to the cleaning it up, stop the tax planning. So that can be kind of a wake up call too, where people kind of get caught.
It's kind of balancing those two, right? Because there's something that may make sense from a tax planning perspective.
Absolutely.
But you shared an example of a business owner that you met with who was walking in with this value in their head that, oh, my business is at least worth this. And then once you get through this process, it's like, wow, it's a fraction of what I thought it was going to be.
Yeah, that one will haunt me. It was because, and I'm not throwing accountants under the bus, I used to be one, but they got some guidance from their accountant saying that their business, which was a transportation company, so very heavy asset intensive company, that the right way to value that particular company was to take a multiple of revenue, 1 times revenue. And when we got done with it, I'm going to mess the numbers up probably, but ballpark, it was, he thought it was going to be worth something like $12 to $13 million. Ended up being worth half that.
Wow.
When you actually looked at what that fleet could generate, what cash flow was available to owners. We also kind of in that situation looked at the liquidation value of the assets. So those shortcuts and rules of thumb are dangerous. So making sure you get in there and really do the work to understand how the business operates, how it's going to generate that return to get a good sense for what the value is.
With thousands of qualified integrators and suppliers, the CSIA Industrial Automation Exchange is your one-stop spot to identify and connect with a diverse community of integrators and suppliers to help you deliver a low-risk and successful project. Using this powerful platform, you can do customized searches and filter by industry vertical, expertise, location, certifications, and more to source the right partners and products for your needs. For SIs and partners, it provides a platform to support your content and SEO marketing efforts, position yourself as a thought leader, and nurture prospects during their complicated buyer's journey. Why not take a minute to visit www.csiaexchange.com and see for yourself? No swiping left, no swiping right. Just connect directly to quality industry experts. It's really that simple, I promise.
That is probably the most common thing business owners are going to hear, right? It's X times multiple of your EBITDA. It's an X times multiple of your revenue, which again, if you're using it for what it is, a directional thing to kind of give you guidance, it's good, but not necessarily something to live off of. I guess, what are your views on just doing those kind of back of the napkin, valuations for business owners?
I'll take first shot on that, Bryan. So our typical playbook or process is before we even are fully engaged by a client, we're talking with them about exploring a sale process. We like to give them I call it a preliminary valuation analysis. And our valuation analysis, and it's going to go through probably a lot of the same mechanics that Jane would on getting to, depending on the company, but a lot of times it's getting to some kind of adjusted EBITDA figure, earnings before interest, tax, depreciation, and amortization. And I use the term adjusted because there could be non-recurring expenses, extraordinary expenses, owner-related expenses. It could be added back, or sometimes they have to be subtracted out to get to the right adjusted EBITDA. In some cases, we can talk about some kind of valuation based off of revenue, recurring revenue, or a hybrid thereof. But from a process perspective, we like to do a preliminary valuation assessment. And ultimately, our valuation is going to be heavily centered on what we know the market is trading at today. And it's part of the benefit for us being a specialist in the automation segment, where we know, if pushed, what buyers are willing to pay. We can kind of divide it out between fair market value and premium value so that we can explain to owners, look, here's kind of fair market and then here's premium value. And a lot of times, of course, we're saying it, here's kind of 150 yards down the fairway, using the golf analogy, you can get on your own maybe, or with not a lot of competition. And then here's going that extra 150 yards down the fairway to get to premium value. And so ultimately, at the end of the day, I think I said this earlier, final valuation is not determined until you run the competitive process and push buyers to pay maximum value. But I don't like to use the term back of the envelope. But if you want to use that, you can. We go a little bit more in the back of the envelope. But I think it's important to do some kind of preliminary valuation assessment, but using real-time market comps to drive that analysis.
Yeah, I'd add on to that the problem we have generally with multiples is exactly what Clint says. We usually will tell clients something very similar, but use the words value doesn't always equal price. So I can come up and tell you the fair market value of your company is X. And just like you were going to sell your house, you sell your house, you listed it $500,000, but you're in a great neighborhood with great schools and there's a housing boom. So somebody will pay you $600,000 sight unseen and no inspection and no whatever. So price and so motivation of buyer and seller is so important, and the psychology of the deals are very important. The problem with multiples is that you don't know what the psychology of the deal was. You don't know if terms were given, if cash was paid up front, what was negotiated. Was there a non-compete agreement? Was there an employment agreement? Was there an earnout? There's so many terms of the deal. I'm sure that Clint could go on forever, and this could be a whole nother conversation about how the deal gets structured that can impact the price. And the price is what drives the multiples. So that's our warning against multiples. Like Bryan said, it's a kind of a good way to kind of just get yourself a ballpark. But if you really are serious about understanding the business value, going through the process and really understanding it is the best way to go.
And one other thing, and Clint, maybe you have some thoughts on this. The other value I see in multiples, especially if they're kind of based on what the current market is that helps you kind of understand a little bit where buyers are coming from, right? And I think maybe the first time we spoke after one of the executive conferences, I think my colleague Tim had asked you that question, what multiples are you seeing today? And at the time, I think you were talking, well, it's maybe 3 to 5 for this, but if you've got a heavy software component, it might be more up in the 6 to 8 or something like that. Am I close on that? Am I misremembering that, or is there? Because the automation space is a pretty wide, you got everything from robot manufacturers and sensor manufacturers to the integrators, those places. You'll see variations across those multiples, right? Depending on what role the company plays in the industry.
Great question. Continuing a trend, I tend to get it all in webinars and conferences. If someone asks me the question about specificity on multiples, so I appreciate you keeping that trend going. I'll give you an answer to your question, but first, multiples, when I'm talking with a client, a preliminary valuation assessment, they're a starting point, not the ending point on valuation. And I make that clear to them. I'll Mr. Client, I'll give you a range of multiples, fair market premium. This is just a starting point. It's not the final answer to the test. The process is the final answer to the test. And the other thing I note is for no company out there, there's no perfect comp out there for any other company. Every company is unique in its own fashion, which thereby translates into its own multiple or multiple variations. So those are kind of forgive me for the two investment banker disclaimers. Now with those out there, let me kind of more directly answer your question. So if you're talking about pure control systems integration, I mean, we've seen over the past 6-7 years, the multiples have gone up without question. The reason for that is because there's more demand from a buyer side, whether it be private equity or strategics, than there are supply of potential sellers. And we don't currently see that trend abating anytime in the near future, especially when you look at the growth and market trends of the automation space, which all of us here on this webinar have seen those stats. You know, you've got like the JR Automation comp, which traded a few years ago when Crestview sold that. And that was just, let's call it a 15 to 20 times EBITDA multiple. Now, that was a really large company that sold to a highly strategic buyer. But that multiple, I get a lot of owners quoting that multiple to me. I know the exact multiple. I'm not going to say it exactly, but it's in that 15 to 20 range. But what I'd say is even down now to what I would call the control system integrators who are doing kind of 1 to 2 in adjusted EBITDA, we've seen their multiples go up. And you could be talking, you know, up into potentially the high single digits or into the double digits in terms of EBITDA multiples. Where if you'd have told me that 7 years ago or 8 years ago, I'd say, no, that feels a little out of reach. And then you get into the software-driven companies, and then you're talking recurring revenue and your whole different zip code. So hopefully that gives you a little bit of context on the question.
Well, and really, I think where the question was coming from is that, again, that's a box an owner in on. If you do this, you're going to get 7. If you do this, you're going to get 10. But as you mentioned, the companies with that higher software end of it, the multiple starts going up. You know, what it's going to be, you know, I won't say it's going to be 2 or 3 times. But if I'm sitting back as a business owner who's, you know, still got 20, 25 years of runway left in my business, and I'm facing a decision of, do I focus more on the software side of my business or do I focus more on this other side over here? This is another data point they can look at and say, well, hey, if I'm looking to grow my value, this service may offer a higher multiple than this other service over here.
Can I say what you said, but in a different way? The software,
as long as you say it better, because
I guarantee it won't be better, but it'll be a different way. Software, it can be higher, but it's going to be valued differently. But what I would encourage owners, and I give this kind of spiel to a lot of owners in the system integration space, do whatever you can. You don't necessarily have to go build a software platform to go higher valuation, but what you can do is focus on building more recurring revenue. Sometimes we use the term recurring like revenue. There can be a lot of different ways to accomplish that. Multi-year contracts or demonstrating, hey, we're working, we're project-based, but look, we can show over a 5-year period. We're just going for the same client from one project to the next, to the next, to the next. Well, we as the investment banker can take that and position that to buyers is that's recurring revenue. Once they get the foot in the door of the client, is repeatability. That recurring revenue usually then drives up valuation, leverage in negotiation and valuation standards.
We've hit on a few things here, which kind of fall into those general umbrellas that Jane talked about initially, you know, kind of the risk and the cash flow. You know, from a risk standpoint, you've got your concentrations of customers, even you can have concentration of vendors if you're very dependent on a particular technology, as we've seen with supply chain issues here. When you start talking about cash flow, now you're getting into some of more maybe the financial reporting type things. Ben, to bring it back over to you, what are some of the ways that you've seen business owners try to monitor this within their business?
You know, I think it starts with talking to Clint, talking to Jane, understanding what those aspects of your business are or the areas of opportunity are in your business to drive value. And once you have identified those, you can monitor them in a few different ways. But what I'm seeing become a little bit more prevalent and popular now is people using technology, so using kind of dashboards and real-time data to start tracking some of these things that we've talked about today. Like when Clint talks about, you know, your software revenue looking at what customers are recurring versus not recurring, and really getting comfortable with that data set and kind of segmenting your business in that way. There's some good technology out there that help people implement. And I say that because dashboarding technology might be something that folks on the call looked at 5-6 years ago and say, hey, it's not a fit for us. It costs too much. It's too much to implement. That dynamic has changed a little bit. Those costs have come down. So I think that there's some great tools out there to help them segment and look at their data on a real-time basis and watch what's happening in their business and measure, more importantly, how well their initiatives are working, I guess. So outside of that, I think that it's just important to measure in general. So start getting a management reporting package together. Look at it on a monthly basis, look at it on a quarterly basis, look at it on an annual basis, and look at it from what are my recurring customers? What's my software revenue? What are my revenue streams there? What are my costs? That type of thing. And that can be something that maybe your CFO, your VP of finance, your controller can start putting together for you. And even if you're a single owner, I see a lot of times that single owners say, I've got a pretty good sense of my business and where it's at. So, I don't necessarily need all that management reporting that you're talking about. But I'll tell you that once you talk to Clint, once you talk to Jane, you'll understand that business owners look at your business and your data potentially much differently than you do. And it's a great idea as a single owner to take a step back on a quarterly basis and look at the story that your data is telling and look at the direction that your business is going.
One area that financial reporting, financial management that Jane specifically mentioned it, but it's been underlaying in everything else we talked about, is really the forecasting and your ability to hit those forecasts, right? And I know most every business probably at least goes through an annual budgeting process. And usually then that budget goes on a shelf for 12 months and then you dust it back off. What I know you kind of advocate for is making that part of your process, because I think Jane mentioned that that's something that, buyers are going to look at and say, hey, how well can you forecast this? Because if you're coming and telling me that you're going to grow by 10% next year, prove it to me. You have a history of being able to forecast and then match your forecast. So that comes into play as well, right?
Absolutely. Yeah, you're spot on. And if you're listening today and you don't have a budget, I'll say that you're not alone. But I think that's a huge area that people can focus on to drive value. Once you kind of start trying to budget, you understand what you need to work on. You get a little bit better sense for how to do it a little bit more efficiently. I'll say, they're never going to be 100% accurate, but the better you are at demonstrating that you have a handle on your business and you have a handle on hitting historic budgets, it just increases a buyer's confidence in your knowledge of what's going to happen to your business in the future. So going back to what Jane said earlier, that just gives more confidence in future cash flow.
And realistically, sometimes being overly conservative in those budgets can be just as impactful, right? That, hey, we always over budget for this and we come in under, so we end up being more profitable. But from a buyer's perspective, it's like, well, did you not understand what was going on in your business and you just got lucky? Or, if not, why were you over budgeting for that? Because now that's capital that could have been deployed somewhere else, et cetera. So.
Yeah, I see that as well. And, I'd say that to a degree, engineers and CPAs are kind of in the same realm in that they might be a little bit more risk adverse. So it's like, I don't want to throw anything out there that I can't hit. And while I don't disagree with that, being overly conservative for the sake of being conservative also isn't the right answer here.
Yeah.
Are your accounting systems optimized for the needs of your system integration business? Do you understand the KPIs critical to business performance? And are you prepared to proactively manage your short and long-term cash needs while minimizing your tax liabilities? Well, I've got some super exciting news to share about a brand new CSIA financial checkup program brought to you by long-term member Clayton McKervey, CPAs for System Integrators. Now, if you are a CSIA member, you will have access to this exclusive program designed to bring you support in 4 key financial areas: accounting systems, performance metrics, tax planning, and cash management. Plus, CSIA has negotiated special member pricing and packages at various price points to fit your budget. Clayton McKervey has helped many CSIA members over the years and is super excited to help you improve your financial performance through this program. To learn more, visit www.controlsys.org/check.
So, I think probably the underlying theme of this whole conversation is really to critically look at how your business is going to look at a sale, and then focus on those areas that the potential buyer is going to focus on, and really try and tighten up your practices, your policies, all sorts of things like that. So that when it gets to that point, like you said, Ben, yeah, maybe I'm not looking to sell in the next 5 years, but that doesn't mean I shouldn't be starting to act like I might be ready for sale in 5 years. So Clint, let's go to the other side of the spectrum. The person that gets that phone call tomorrow saying, I want to buy your business, and didn't have time to put any of these things in place, kind of get themselves ready for sale. What advice do you have for the owner that fields that call and maybe things aren't as well in order as they should have been?
Yeah, it's a good question. We get those phone calls a lot from owners. In fact, we just did our own for our internal company, did a podcast on unsolicited offers, and we're going to put it on our website, just put that plug in. But look, all owners today are getting phone calls from buyers on an unsolicited basis. That is just happening, and they're getting them multiple times a week. And for an owner, that creates a decision point. Do I go down this path and talk to this one buyer and see where that leads? Or option 2 is just, I don't do anything. I ignore it and just keep doing what I'm doing. Or option 3 is, do I think about, well, if I'm going to talk to one, maybe I should really find out the real value of this business and, create a market value, and maybe, bring on a Bundy Group to run it, or bring on a Clayton McKervey to do a sell side quality of earnings report. And every owner at the end of the day, of course, has to make their own decision. I will tell you that a lot of owners think, and Ben may have some thoughts on this too. I think a lot of owners think, well, if I go down the unsolicited route where I just take the one call, I'm saving time and energy and can hopefully get my number that I want. Well, I think most owners will tell you who've gone down the unsolicited route that at the end of the day, they probably ended up spending just as much time and energy and expense going the unsolicited route as they would have had they gone let's go to market and test the market route. They just spend that time and money in different ways on the unsolicited route, and frankly can increase their stress because they haven't done the preparation. Back to my earlier phases, they haven't really done the preparation phase. What they've done instead is jumped ahead and jumped into the signing of the LOI phase, which then gives the buyer all the advantage. And then the buyer comes in with their transaction accounting team with the sole goal of beating up the owner and trying to make use of limited information to squeeze them on pricing value. So what we would say is, we're biased, of course, but we think an owner maximizes value and reduces stress by doing the 3 phases that I articulated earlier, and doing it the right way, and then thereby maximizing value.
I would agree and echo what Clint said. I've seen kind of both types of processes happen, and there is no free lunch. It costs at the end of the day. And I'll say too, if you think about corporate developers, they're out there looking for the person that's not prepared and knocking on those doors for a reason, because there's better value for them. So I think that Clint is spot on with his advice there.
That was everything we had on our original agenda. There were no questions that come in. I don't know if anybody has any additional questions they want to put in?
I'm popping out of my trash can.
Oh,
so maybe this is a very basic question, and you can tell me to shove off, but I hear a lot about how system integrators are reluctant to tip their hand, right? They may be interested in fielding some sales or, being approached, but they don't want to raise their hand out there because then that makes their employees get a little nervous, or, they just maybe don't want to lift their skirts, so to speak. Mm-hmm. What would be your advice for somebody in that position? Like they might consider selling, but they don't know how to go about finding anybody to buy them.
I'm happy to take the first shot at that, Bryan. My father, who founded our company 30 years ago, has had a statement for 30 years, which is still very applicable today, which is motivation is the foundation of all transactions. Motivated buyer and motivated seller. And so if an owner who's getting these calls or starting to think about some kind of sale, they probably need to start with the emotional side before they get too far down the analytical side, which is, why do I want to do this? What's the motivating reason? Because to be honest with you, the analytics side, whether it be Ben getting involved or Jane getting involved or me getting involved as an investment banker, that's actually a lot easier in some ways to figure out than the emotional side. So I would say if I'm an owner first, assess, well, why am I even going to think about this? Once they've sort of checked that box, I think you've got 4 people on this panel here today that you can pick up the phone and call any of us to say, well, I'm thinking about this process and I need some advice. From your perspective, what are next steps? And all 4 of us may have a little bit of a different angle or approach, but at the end of the day, we're going to probably lead back to similar endpoints. Bundy Group's process may be, well, let's talk a little bit about the emotional side, and let's talk a little bit about the valuation ranges their company could be, and then we'll talk about process. I'm sure Ben, who, not to speak for Ben, but he would maybe attack it a little bit differently, and I'm sure Jane would too. At the end of the day, though, seek the advice of someone experienced in the transaction world tied to automation, system integration, because they'll give you some good advice on next steps.
Yeah, and I think, Lisa, you bring up a very good point. 'Cause I know that even, I've had some, and Jane, I think you and Kathy mentioned this too. We've had business owners, they don't want anything about transaction or sale or any of that in meeting notices because people see calendars and then people start getting nervous. But the one thing that I like about working in the small to mid-sized business space is the business owners typically, I'm not going to say all of them, but the vast majority care about their people that work for them and want to make sure that, hey, whatever my exit is, the company, the people are still taken care of. And maybe that's an ESOP. Maybe that's a key man plan where I'm going to bring up a few of my top employees. And so they really shouldn't be nervous about that. They should actually kind of embrace it and say, we all know eventually I'm going to have to retire. And so I'm trying to do everything I can to make sure that there's continuity, that you have a job the day I walk out the door and that you're going to be taken care of. You're not going to bring everybody into these conversations and have them sit in the conference room, but be open about the communication that this is what I'm looking at. This is where I'm trying to get to, particularly the couple clients we've worked with who are talking about having key employee equity sharing plans. To go from being an engineer to a business owner is a huge transition. So there's a lot of development and education and coaching that has to go on to get those people ready for those kind of transitions. So it's better to be open and honest about it and communicate clearly. Unless you're just trying to cash out and leave in the middle of the night with as much money as possible, then you probably want to keep that to yourself. But I don't think most of the business owners I work with have that approach. All right, well, we're coming close on our time, and I want to be respectful of all the attendees' time here. So I'm going to give each of the panelists a chance to kind of give their last piece of advice. Jane, I'll let you lead it off. What are your final words of advice to the people on the call?
Whether or not you're heading into an imminent transaction, you're getting ready, it's in 5 years, it's, wherever you are in the process, it's so important for us as business owners to just stop for a minute working in our business and work on our business. So all of the different things that we talked about with the different risk levers and everything, culture and customer relationships and management diversification and all of those different kinds of risk factors that we talked about, reducing those risks. Even if you're not heading imminently into a transaction, will create a better culture, create a stronger company. And so the more time that you can take and be disciplined to work on your business, and you set the right amount of time, is that once a month, a quarter, 6 months, hopefully not just once a year, but, so take some time and really devote to what can I do to come at it from a business value perspective. But even if, like I said, you're not heading imminently into a transaction, it can be so important just in being able to attract employees, retain employees, customer relationships, people that love to come to work. So taking that time, that's my advice, is to take the time to work on your business.
Clint, your final thoughts?
Jane covered a lot of good stuff there that I'm not going to duplicate, but I would just say for owners, going to want, whether they're thinking about a sale or a recapitalization down the road or not, always be thinking about building value, building the company in the right way. using a lot of the kind of the key fundamentals we talked about today. And I would just encourage, and again, I think we've got 4 great people on this panel today, use the advice and use these sort of experts active in the automation space as sounding boards. And I'm sure Jane and Ben have open door policies just like I do, because knowledge gives you ultimate power and helps you build more value. So that's my kind of part.
All right, Ben, your final thoughts.
Yeah, no, I agree. And I would say, kind of going back, working on business value is a win-win. So it doesn't have to be, hey, organization, I'm thinking about an exit. We're doing these things because we're better for it. So there's a different light. You don't have to break confidentiality. You're kind of starting to work on these things.
If you enjoy this podcast, please subscribe in Apple Podcasts, Stitcher, Google Podcasts, or wherever you listen to podcasts. You can also help others find us by leaving a 5-star review and sharing your favorite episodes with colleagues. Thanks for listening to the Talking Industrial Automation podcast. Thanks also to bensound.com and Wistia for the music bumpers. Until next time.